You know, the stock market can feel like a total whirlwind, right? It's just chaotic. So what you really need is a reliable guide, a compass to point you towards solid ground. And today, we're going to build that compass piece by piece.
It's a pretty intense quote from Baron Rothschild, but it gets right to the core of value investing. It's all about thinking differently. It's about seeing a huge opportunity when everyone else is just seeing panic and fear. Basically, it's the exact opposite of following the crowd.
Okay, so that's the real question, isn't it? It's easy to say you'll be brave when others are fearful, but how do you actually know what to buy? How can you tell the difference between a genuine bargain and a company that's just, well, going down the drain? That's the case we're here to solve.
And if you look at history, it's full of some pretty serious warnings. Just think about the Harshad Mehta scam back in '92, or the 2008 bubble. These are perfect examples of what happens when hype completely takes over and solid analysis gets tossed aside. People lose their life savings. And that's exactly why we need a framework, to protect ourselves from that kind of madness.
Our investigation doesn't start with just one company. Nope, we start with the entire economic landscape. Before we zoom in on any single clue, we have to survey the scene. We need to know what kind of environment we're even dealing with.
Now, what's so fascinating about this cycle is how it lines up with how people feel. Most people get really excited and jump in to buy during a boom, right at the very top. But what fundamental analysis shows us is that the real opportunities are usually found way down here, in the middle of all that pessimism during a depression, or right at the start of a recovery.
So, to figure out where we are in that cycle, we need to be detectives and track the clues. Is the economy actually growing, or is it shrinking? In a country like India, something like a good monsoon can literally lift the entire economy. Are interest rates climbing, making it harder to borrow money? Every single one of these clues tells us a piece of the bigger story.
And this right here shows you exactly why that big picture matters so much. If you think a recession might be around the corner, well, investing in cyclical industries like cars or tech could be a really bumpy ride. But defensive industries, the ones that sell things we all need no matter what, they tend to do just fine. It's all about picking the right tool for the job.
All right, so we've surveyed the scene. Now it's time to zoom in on our person of interest, the company itself. We're about to open up the case file and examine all the evidence, piece by piece.
Think of this as our detective's toolkit for the qualitative stuff. First off, who is running the show? If the leadership keeps changing or they're constantly arguing with their accountants, those are huge red flags. Then, what does the company actually do? Is it holding its own against competitors, or is it losing ground? And finally, the annual report. Don't just flip through the shiny photos, read the fine print. That's where the real story is hidden.
So, the qualitative stuff gives us a feel for the company's character. But to really know what's going on, we need cold, hard evidence. And that means we have to dig into the numbers, the financial ratios that tell the real, unvarnished truth.
First up is return on equity, or ROE. This basically tells you how much profit a company makes for every single dollar that shareholders have put in. Think of it like a report card for profitability. Anything over 20%, that's an A+. It means the management team is fantastic at using your money to make even more money.
Next, we look at the debt-to-equity ratio. This one is all about risk. I mean, a company that's drowning in debt is in a really tough spot, especially if the economy slows down. A ratio below 0.5 suggests the company is standing on solid ground, not on a shaky mountain of borrowed cash.
But out of all the numbers you can look at, there is one comparison that is the ultimate lie detector test. It just cuts through all the accounting fluff and shows you what's really happening inside the business.
And this is it. Is the actual cash coming into the business greater than the profit it's reporting on paper? Now, why is this so important? Well, because accounting rules can let companies report profits long before any actual cash hits their bank account. If a company keeps showing huge profits, but isn't actually generating cash, something's fishy. Cash is king, and this question takes you right to the throne room.
So, we've looked at the economy, the industry, and the company's health. Now it's time for the final step in our investigation, putting it all together to figure out what the company is actually worth. It's time to solve for X. This right here is the holy grail of fundamental analysis, intrinsic value. This has absolutely nothing to do with the stock price you see bouncing around every day based on news and emotions. Intrinsic value is the true, deep-down worth of the business, what a smart, logical person would pay to own the whole thing. The math for this can look pretty scary, I'll admit, but the logic behind it is actually really simple. First, you guess how much cash the company will probably generate in the future. But a dollar you get tomorrow isn't worth as much as a dollar you have today, right? So step 2 is to discount all that future cash to see what it's worth right now. You add it all up and boom, that's your intrinsic value.
Phew, we've covered a lot of ground, from the huge economic picture all the way down to the nitty-gritty details of valuation. So let's wrap it all up into one final, super useful tool, your master checklist.
This is it, the whole process, from top to bottom. You start big, looking at the economy and the industry. Then you zoom in, checking out the management, the financials, those key ratios, and of course, the cash flow. And only if a company passes all of those checks do you ask the final and most important question: can I buy this for less than it's actually worth? And that leads us to one last absolutely critical idea. See, it's not enough to just find a great company that's priced fairly. To really protect yourself, you need a cushion. You need a discount. And that cushion is called the margin of safety. The greatest value investors swear by this. Let's be honest, your calculations are never going to be 100% perfect, and the future is always a little uncertain. This margin of safety is your protection against being wrong. Buying a stock that's worth $100 for just 70 or 75, that gives you a buffer. It's the seatbelt for your entire investment portfolio.
And just like that, you've built an investor's compass. You now have a system to look right past all the noise and the hype, to analyze the evidence and figure out the real value of a business. The tools are in your hands now. The only question left is, where are you going to start your investigation?